So good afternoon. My name is Carlos DaCosta, Chair of the MES Discussion Group. I'm delighted to welcome you to our Wednesday, April 30th, 2025 Discussion Group Seminar. Jackie Allison, Chair of CIM MES, will be assisting us with this session. Today, we are honored to feature Bill Roscoe, who will be presenting on the topic is the net present value of a preliminary economic assessment indicative of the market value of a mineral property. Dr. Roscoe is a geologist with more than 50 years of experience. Bear with me for a second. More than 50 years of experience in the mining industry in Canada and internationally after working as an exploration geologist and consultant. In 1985, he co-founded Roscoe Postle Associates. A bit about CIM. Yeah, a bit about CIM. The Canadian Institute of Mining, Mineralogy, Petroleum Association is a nonprofit technical society representing professionals from Canada's minerals, metals, materials, and energy sector. CIM was founded in March 1898. CIM is comprised of 11 societies and has branches organized geographically into three distinct districts across Canada: Western, Central, and Eastern. The Management Economic Society, aka MES, a society within CIM, encompasses members who contribute to all aspects of the management and economics of companies active in the mining sector. Through events like this one, MES provides platforms for industry professionals to exchange insights and ideas on economic management and financial topics in mining. Everyone is welcome to join CIM MES. We want to, extend our gratitude to our generous sponsor, IAMGOLD, for sponsoring this event. And we also want to thank the CIM Foundation for generously sponsoring this event as part of the CIM Distinguished Lectures series. We encourage audience participation. So should you have any questions during Bill's presentation, please feel free to type them into the chat box in the menu. We will read them to Bill so he can answer them during the Q&A session at the end of this presentation. So without further ado, please join me in welcoming our guest speaker, Dr. Bill Roscoe. Thank you very much.
Thank you, Carlos. I'm just going to get my screen up here. If I can figure out how to do that.
Sounds good. And as I said, if you would like to ask a question for Bill, by all means, we encourage you to go into the menu, and there is a little box that basically says chat. So just input your question, and after his presentation, we'll read out the questions to Bill.
Okay, thanks again, Carlos.
You're welcome.
So good afternoon, everybody. So the question, I think, as Carlos has mentioned here, is the net present value of a preliminary economic assessment indicative of the market value of a mineral property. And so we're going to talk about initially some definitions and concepts. I'm going to make a distinction between valuation and evaluation, talk a little bit about net present value and discounted cash flow. And then we'll look at two types of properties, one type that's transacted that has PEAs, and the other type of property that's non-transacted properties. And for each of these, we're going to compare the net present value at the discount rate used in the PEA with, in the first case, the transaction value, and in the second case, the adjusted market capitalization, which we're using as a proxy for property value. Then we'll talk about discount rates for valuation and evaluation. So just by way of caution here, the information used in this presentation is from public sources and subscription services, as well as company websites. We've used a lot of our detailed information on PEAs is from CDAR, and the US equivalent to CDAR, a few of them called EDGAR. And then we've used the S&P Global Market Intelligence, which SLR Consulting subscribes to source a lot of the information. The views expressed here are my personal views and don't necessarily represent the views of SLR or other SLR employees. And I've suppressed the names of the gold properties used in this study so it doesn't distract from the concept and the analysis presented here. I want to acknowledge the contributions of my co-authors and colleagues, Pierre Landry in Victoria, Paul Chamois in Toronto, Graham Clow in Toronto, and Grant Malinsek in Denver. I also wish to acknowledge the support of SLR Consulting Mining Advisory, the CIM Foundation, and the Canadian Mining Hall of Fame for proposing me as a CIM Distinguished Lecturer. I want to make a distinction between valuation and evaluation with reference to a mineral property. Valuation is the value of a mineral property in money or monetary equivalent, and the words value and valuation can be used to refer to the estimated value or to the preparation of a valuation. Whereas evaluation is a broad physical, technical, legal, economic, and or other assessment of a mineral property that's generally done for an investment decision. And evaluations include feasibility studies, pre-feasibility studies, preliminary economic assessments, etc., as defined in the template produced by the International Minerals Valuation Committee. And an evaluation may be used in the process of evaluation or as a basis for evaluation, but not as a valuation per se. The value is commonly expressed as a market value or fair market value. It could be other types of value. It's going to read this definition of market value, which is similar in other definitions. It means the highest price expressed in terms of money or money's worth, obtainable in an open and unrestricted market between knowledgeable, informed, and prudent parties, acting at arm's length, neither party being under any compulsion to transact at a given point in time. And a market value can be established by an actual transaction on the property or by a valuation by an appropriate expert. So this table shows valuation approaches for different stages of exploration property or mineral properties, exploration through to production. The three evaluation approaches are income, market, and cost. We're only going to talk about the income approach today, which generally means a discounted cash flow analysis, and which is used not on exploration properties because there's not enough information, but for mineral resource properties that at the study stage, that is the evaluation stage, and we won't talk about development or production properties today, but talk about mineral resource properties that have had PEA done on them. An evaluation is different types of economic studies, as mentioned. First, the initial stage with the lowest confidence level is a preliminary economic assessments, which is an early stage evaluation of a mineral property, which may include all categories of mineral resources, measured, indicated, and inferred. And it includes assumptions, limited technical, financial, and permitting detail, purposes to justify additional expenditures to advance the property and to identify where more information is required for more detailed evaluation. And a pre-feasibility study is a more detailed evaluation of technical and economic viability of a mineral project. And it's at a higher confidence level than a PEA. And in it, only measured and indicated reserves can be used to be converted into mineral reserves if they're demonstrated to be economic. And then a feasibility study is a comprehensive technical and economic study of the selected development option for a mineral property. And it can serve as the basis for a production decision on a property. It defines mineral reserves as well, and or it can be used for financing of development of the property. And all of these economic studies include a discounted cash flow analysis. So what's a discounted cash flow analysis? I suspect that most people listening today are quite familiar with the discounted cash flow analysis, which can be used in either the valuation or an evaluation of a mineral property. And the DCF analysis involves projecting a future stream of cash flows from an operating or a mine or a potential mining operation on an annual basis and discounting them back to the present time using an appropriate discount rate. This results in a net present value or NPV. The projected cash flows consist of revenue generated by mineral production at an appropriate commodity price or prices minus different types of costs, operating costs, royalties, capital costs, taxes, and so on. And in the earlier years, the cash flow is dominated by pre-production capital expenditures, generally resulting in negative cash flows. The discount rate should include the borrowing cost and project risk, which we'll talk more about a little later. And the NPV may be reported on a pre-tax or an after-tax basis. Here we'll be talking about after-tax basis. Here's a simplified example of a discounted cash flow on an after-tax basis. You can see the project, my pointer here. The first couple of years are -1, -2 are the pre-production years in which capital is expended to put the property into production. And then there's 7 years of production in which revenue is generated. The ounces of gold here are shown in thousands, and starting primarily in year one, the production 56,000 ounces, 58,000 ounces, and so on, annually adding up to a total of 377,000 ounces. And then the revenue generated by sale of the gold that's produced, shown in the next line here, 133 million, 139 million, and so on. And then the next line is operating cost, which is shown as a negative here because it's a cost rather than a revenue. In the production years, 51 million minus 52 million, 44 million, and so on. Capital cost is shown in the next line. You can see the first 2 years, it's minus 45 million, minus 98 million to put the property into production, with still some on first year of production. And then it's mainly sustaining capital just to replace equipment and so on, keep the operation going. Last couple of years, it'll be closure and reclamation costs and ongoing monitoring and so on. And the final line here, the semifinal line here, is taxes, which we all enjoy paying, and adding up to 139 million over the life of the operation. So the cash flow is the revenue minus the different costs here, in this case, the operating cost, capital cost, and taxes, to result in the annual cash flow, minus 45 million, minus 105 million in the pre-production years, and in the production years, 44 million, 59 million, and so on. And then the total cash flow adds up to 183 million over the 7-year life of mine, including the pre-production negative costs. And this gets discounted if it's discounted at a 5% discount rate, which means it's discounted 5% and then 5% and 5%, 5%, 5%, and 5%, and so on. We end up with a net present value of 117 million at a discount rate of 5%. When we discount at 10%, it's 72 million. Discount at 15%, it's 39 million, and so on. So this chart over here shows that graphically. So you can see that the net present value is quite sensitive to discount rate. There's the undiscounted value here, or again, discounted net present value at 0%. And then at 5%, 10%, 15%, and so on. So you can see it's discounted substantially from 5% to 15 or 20%. The final note here is the internal rate of return, which is the discount rate at which the net present value reaches 0. And then if the discount rate's higher than that, it becomes negative. So in this particular example, it's the internal rate of return is 25%. So let's turn our attention to transacted gold properties that have had a PEA done on them, and that have actually, the properties have been sold. So we've compiled information on numerous mineral properties located in Canada and the US over about the last decade. And the transaction dates are range from 2016 to 2023, and the PEA dates are primarily within a year or two of the PEA. In some cases are a little bit different. We've got 17 transacted properties that we've found that have 11 of the transactions are on the actual asset itself. Easy to determine the value of the deal. That's the value of the assets that changed hands. 6 are corporate deals. For the corporate deals, the PEA property was the major asset of the company acquired. Most of these are junior companies that have filed PEAs on CEDAR or EDGAR, and the deal prices are adjusted to 100% if they're not for 100% of the property. Transaction date was the date of the announcement of the deal, and all the NPVs here are after tax. And most of them were on a discount rate of 5%, except that 3 were at 7, 7.5, and 8%, but 5% is the main discount rate used here. So question is, how do the NPVs compare with the property values? And if they don't compare, what discount rate would make the NPV equal to the property value? So just keep these questions in mind as we go through the information here. So here's our transacted PEA properties. These are just the Canadian properties. I've divided them into Canadian US just for convenience of illustration here, just to show, because you wouldn't be able to read them if I put them all on the same screen. I've assigned a property code to the property. Here's the PEA year, the deal year, which are mostly within a year or two. And here's the discount rate here. They're mostly 5%, as you can see, with some of them a little higher. And the after-tax discount rate is shown in this column here, 12.4, 189.780, and so on. The deal price is shown in the next column. So if you just kind of take a quick look at these numbers, you can see that in all these cases, the after-tax NPV is higher than the deal price, the price that the property actually transacted for. And and in most cases, the difference is substantial. This column shows the ratio of the deal price to the net present value. So you can see the nature of the difference between the two. It's 0.15, 0.21, 0.11, and so on. The average of these is 0.24, which shows that on average, the after-tax NPV at 5% or so is 4 times the price of the deal. And since these are all different, the after-tax NPVs are all higher than the deal price, we've calculated the discount rate at which the NPV will equal the deal price. As you can see, as you increase the deal price, the NPV goes down. So we've changed the deal. I've all changed the deal price until I get a match between the after-tax NPV and the deal price. So that's what this column is here, 36%, 10%, and 35%, and so on. These are the deal prices that are required to equalize the two. So the averages are shown here, the average and the median values. You can see there's quite a difference between the average and the median here, and that's because this one very high value influences the average more than the median. The same price with the deal price, 48 and 39. The average is influenced by one high value here, and 0.24 is the average ratio, 0.15 is the median, and the average discount rate is 26 and 24. But you can see that there's one, I have to refer to my notes here. There's one very high value here of 69% discount rate, which is based on a fairly small deal. So if we exclude that one, then the average is 21% with a median of 22%. So here's the ones in the US. Again, the same information, the property code, the PEA year, the deal year, the discount rates are all 5% here. And again, you can see that the after-tax NPV is all substantially higher than the deal price. And the ratios are shown here, the ratio of the deal price to the NPV, 0.2, 0.06, 0.77, 0.18, and so on. Similar pattern to what we've seen for the Canadian properties. And here's the discount rate that we had to use to equalize the NPV with the deal price, 17.33, and so on. And they're similar to the Canadian ones, average of 17% and 15%. The next slide shows, just illustrates the difference between the NPVs, which are in light green here, and the deal price, which are shown in the darker color. So you can see that I've divided these up into 3 groups because it'd be just to show the levels of NPV here. This is the highest group of NPV. So you can see that, with a couple of, one exception here, really, that the deal prices are significantly higher than the NPV. For the second group, the middle group of NPVs, you can see that that's the case here, except for one that's fairly close. You can see again the significant difference between the two. And in this one, you can see the lowest group. You can see again that the NPVs in light here are very different than the deal prices. This is a histogram of the discount rates that we needed to use to equalize the NPV to the deal price. They range from -10, 10 to 15, 15 to 20, 20 to 25, and greater than 25. There's 4 deals that are greater than 25%. The average is 20% for these, which excludes that high discount rate of 69%. The average is 20% with a median of 19%. And if we take the middle 50% of these, the range of the middle 50% of the discount rates is 12% to 30%. So this just summarizes the information on the deals here with the 11 Canadian deals and the 6 US deals. I have to keep flipping the page because the pictures here cover the bottom group. But if we take the 17 deals all together, we have an average after-tax NPV of 211 million with a median of 97. And for the deal price, the average is 63 million with a median of 17 million. So the average ratio for all these, the ratio of the NPV to the deal price to the NPV is 27.27 and 0.17 for the median. And then the discount rate is averages 20% for the median and 19%. So we'll move on now to properties that did not transact but have had a PEA done on them. These are all junior companies, Canadian and US junior companies, listed mostly on the TSX Venture, some on over the counter, located in Canada, the US, with the over about the last transacted, or no, sorry, that had the PEA over about the last decade, and 28 in Canada, 20 in the US. And in all these cases, the PEA property was the major asset of the company holding the property. So that we've taken the market cap of each of these companies and adjusted it by working capital to come up with what seems to be, or what we're taking as a proxy for the value of the asset that was transacted. So that is the adjusted market capitalization of the company. We're taking as a proxy for the property value of the market value of the property. So these are at the date of the announcement of the PEA, and the market capitalization with the shares outstanding at the time, times the average share price for the week after the announcement. And we've adjusted that by working capital, because if there's cash or debt in the company, that's obviously not part of the asset value. So we've adjusted that to come up with an adjusted working capital. And the NPVs are all after tax. They're mostly reported at 5%. And so let's ask ourselves that same question again. How does the NPV compare with the adjusted market cap of the owner of the property, the company that owns the property, that owned the property, and what discount, and if they're different, what discount rate would make the NPV equal to the adjusted market capitalization? So here's a list. These are presented a little more abbreviated form here. These are the Canadian properties. There's 14 on this side and 14 on this side, showing the property code for the properties. I've numbered them instead of letters. And the next column for each of these is the after-tax net present value, shown here and over here, and the adjusted market cap is shown here and here. And just by looking down these two columns, you should be able to see that in all cases, the after-tax NPV is higher than the adjusted market capitalization, the same as we saw for the transacted properties. And the ratio is shown in the next column. That is the ratio of the adjusted market capitalization, which we've used as a proxy for the property value, is through the NPV, 0.24, 0.09, 0.7, and so on. Same thing over here, 0.18, 0.05, 0.17, 0.31 is the ratio. And then the final column on both sides here is the discount rate that we've had to use to equalize the net present value to the adjusted market capitalization. 11%, 14, 10%, 41, and so on. Over here, 20%, 27, 20, and 16, and so on. So the average of these is for the ratio. The average ratio is 0.26, and the median is 0.19. And for the discount rates, the average is 18% with a median of 17%. Here's the US properties, the same format with the after-tax NPV, the adjusted market cap for 10 of them over here and the other 10 over here, the adjusted market cap here and the average, the NPV. So we can see that, again, there's a big difference between the two, and that's shown by the ratios of the market cap to the NPV, 0.04, 0.21, 0.43, and so on, 0.49, 0.31, and so on, averaging 0.2. And this 0.2 tells us that on average, the after-tax NPV at a discount rate of 5% or so is 5 times the adjusted market capitalization of the property. So 0.2 is the average, 0.15 is a median. And so, and then for the discount rates, the average is 0.23 with a median of 0.21. So I'm showing graphically again here the difference between the NPVs shown in light green and the adjusted market cap. So you can see that for the highest quartile, the highest 25% of them, with up to 25% with the highest NPV, the substantial difference between almost all of them, and the second highest quartile, again, the substantial difference between almost all of them. And then if we look at the second lowest quartile, again, the same pattern. And then the lowest 25% of them, there's the odd exception where it's not substantially lower, but in almost every case, it's the NPV is substantially lower than the adjusted market capitalization at 5% or so. Here's a histogram of the discount rates needed for the NPV to match the adjusted market capitalization. So you can see it's less than 10%, 10 to 15, 15 to 20, and so on. And this last column here is properties which require a discount rate of greater than 30% to match them. The average is 20%, median of 19% for all 48 of these transactions. And the middle 50% here shows a discount rate ranging from 15% to 24%. So here's a summary of those 48 properties, the 28 Canadian properties, the 20 US properties. You can see that the after-tax NPVs are a little smaller in the US properties because they're just generally smaller projects, and the same thing with the adjusted market cap is smaller in the US ones, but the ratios are similar and the discount rates are similar as well. So for all 48 properties, for all 48 properties, the average after-tax NPV is 263 million with a median of 191, and the adjusted market cap is only 63 million with a median of 29 million, and the average ratio is 0.24 with a median of 0.18, again suggesting on average that the after-tax NPV is 4 times the adjusted market capitalization for these properties. And the discount rate averages 20%, 19%. So these figures are very similar to the figures that we got from the transacted properties, which suggests that on average overall that the and the discount rates are similar as well, which suggests that on average overall the non-transacted properties, the adjusted market cap is somewhat representative of the value of the property, which is our reason for using it as a proxy for the property value. In detail, I think that if we have information on both the differences between the transaction value and the adjusted market cap bounce around a little bit, but overall on average they seem to be similar, which suggests that the adjusted market cap is representative of the property value. Here's a summary of both the transacted gold properties together with the non-transacted gold properties. Here the discount rates are similar. The deal price in the transacted property is significantly lower than the PEA NPVs, which is also the case for the non-transacted properties where the adjusted market cap is significantly lower than the NPV. And the deal price ratios, its averages for the transacted properties, it's 0.27 with a median of 0.17, whereas it's very similar for the non-transacted properties, 0.24, 0.18. And the discount rate is actually the same for both of them to equalize the either the NPV with either the deal price or the adjusted market cap, 20%, and with a median of 19%. So what does this tell us about discount rates? Well, as I've pointed out here, the discount rate in the PEAs is generally 5%, mostly 5%. And 5% seems to be the default rate for preliminary economic assessments in general. And I've talked to companies, I've talked to people, and usually the reply that I get when I ask, why do you use a discount rate of 5%? The reply is usually, well, our peers our other companies are using 5%. Our peer group uses 5%, so we want to be compared to our peer group by using a discount rate of 5%. But when we look at this, we see in the previous slides here, there's a major disconnect between the NPV at 5% and the property value as shown in the market transactions and the adjusted market cap as a proxy for property value. So we've looked at 65 properties here. Not in all 65 of those properties, the market, or sorry, the NPV at a discount rate of 5% or so is significantly higher than the actual value of that property or the adjusted market cap as a proxy for the property value. So this tells us, the market is telling us that 5% is too low for the valuation of a mineral property. And for the valuation of a mineral property is, from what we've seen in the data here, the discount rate to match the transaction value or the adjusted market cap on a valuation basis is higher, in the order of 15 to 25% if we're doing a valuation of property. So I guess, we can say that the value of the property is not represented by a 5% discount rate. So what about a discount rate for the evaluation of a mineral property? Well, my friend Larry Smith, who's done a lot of work, presentations and research and work, and is really an expert or an authority on discounted cash flow analyses, it says that a risk-adjusted discount rate is typically built up from risk components, starting with the corporate weighted cost of capital, weighted average cost of capital, WACC or WACC, and then adding increments to that for the project stage risk, country risk, and other risks that there may be. So here's a typical build-up that comes from an example that Larry uses in his presentations with a corporate WACC of 5%. The incremental build-up is shown on the right here. He suggests using a 5% for a corporate weighted average cost of capital, but that's for a senior company or a senior company or a company that may be in production and have cash flow, compared to a junior company. We're talking about junior companies here today for the most part. And for a junior company, you should add another 1 or 2% to that for junior company risk versus senior company risk. And for the PEA stage, which the PEA being the initial evaluation stage, which a lot of uncertainty in the information involved in that, including and also the use of inferred resources in that at that stage, you would suggest adding a 5% to 7% increment for PEA stage risk. For country risk, Canada, US, it's typically considered to be zero risk, although some people might argue that there should be higher risk for some provinces and some states in Canada and the US. So if we add all these up, we end up with a 11 to 14% range of risk-adjusted discount rate. Another way of looking at it is to see what industry is actually doing. And that's instead of the build-up, let's see what industry actually uses for these different for different levels of evaluation. So Larry and also Ross Lawrence have done surveys, industry surveys over the last 20 years or so, asking companies and consultants or any other interested parties or parties who may do discounted cash flows for the mining industry, what does your practice, what do you do, what do you actually use for discount rates for different stages of evaluation and production? And so these are the results. I've taken the results of several surveys that they've done, the most recent done by Larry in 2023 through CIM. And this is an averaging of the different ranges that they've come up with. And for the these are these discount rates plotted here. And for the PEA scoping level, they're looking at, 12, the average is between 12 and 13%. For the pre-feasibility level, which is a lower risk, it's de-risked, compared to the PEA stage, something 11, 12% is where the average is. At the full feasibility study, which is the definitive study for production decisions and financing, comes down to about 9%. And for operations, it's somewhere 6 or 7%, somewhere in that range. So this is telling us that the industry practice is telling us that 5% is too low for evaluation of a mineral property at the PEA stage. That doesn't recognize all the risks that are involved in that at that particular stage of study. So let's circle back to our initial question. Is the net present value of a preliminary economic assessment at a 5% discount rate indicative of the market value of a gold property? Well, based on the information presented here, the answer seems to be clearly no. An appropriate discount rate for a market value for a valuation should be more like 15 to 25%. And then as a corollary question, is the net present value at a 5% discount rate appropriate for a PEA stage evaluation of a gold property? And again, from the information presented here, the answer is no. An appropriate discount rate for a PEA should be something in the order of maybe 10 to 15%. And the discount rate should recognize the risk inherent in a property at the PEA level. So I think it's fair to conclude that an NPV at a discount rate of 5% does not represent the market value of a mineral property. So when you read a PEA and look at the NPV at 5%, I don't think that you should be thinking that that represents the value of a mineral property. And I think that to a large extent here, a PEA with an NPV at 5% discount rate seems to be more of a marketing tool than an evaluation or evaluation. So I've just got a couple more slides here. Usually in all of these PEAs and other evaluation studies here, they'll typically show the sensitivity of the NPV to parameters such as commodity price, capital cost, and operating cost. And here's a so-called spider diagram with an example here of the showing the sensitivity of the after-tax NPV shown here from 0 to 800 million, showing with differences, increases or decreases in 3 parameters here. The black line here shows the middle line here is with a 0% increase or decrease. Going this way, we have a 10% decrease in the commodity price or gold price and a 20% decrease. So you can see the effect that has. It has quite a large effect on the after-tax NPV. Here, the NPV is shown as something a little over $400 million in the base case. If we decrease the gold price by 20%, the NPV goes to 200 million, so it goes in half. And so it's quite sensitive to gold price. And the same thing as it goes higher at a 20% higher gold price, it goes to 700 million, which is significantly higher. And you can see that there's a lesser effect, but still a significant effect from the operating cost. This is the operating cost here. So if the operating cost is 20% lower, the after-tax NPV goes up to 600 million and so on. And for the capital cost is less sensitive in this particular case. The capital cost, if capital cost 20% higher, the NPV goes up 500 million range type of thing. So this shows the sensitivity of these parameters, but they're all shown at a 5% discount rate, which is not a market value, and it doesn't adequately account for the risks inherent in a evaluation of a PEA. So what's the sensitivity of the discount rate to the net present value? Well, I show that in the next slide here. This is the same spider diagram as we showed in the previous slide. And on the left here is a plot of the sensitivity of the discount of the NPV to changes in the discount rate. Here's our base case here, which is a little over 400 million at a 5% discount rate. But when we increase the discount rate to 10%, that drops to about 300 million. If we increase it to 15%, that goes down to 200 million, or approximately half of the discount of the NPV at a 5% discount rate, which is similar to the sensitivity to gold price, a 20% decrease in gold price, or decreases the net present value to about half as well. So you can see that it's discount, the NPV is quite sensitive to discount rate. So I'd like to recommend, I don't know if anybody listens to it, but I'd like to recommend that the sensitivity of the NPV to the discount rate also be reported for higher discount rates of 10%, 15%, and even 20%, just to show what the true sensitivity is here. Thank you very much.
Okay.
Thank you very much. Carlos, are you going to?
Feel free to take over. How's that?
Okay, sure. All right. Well, I'm just going to thank Bill for that presentation and leading us through all the numbers. I did want to let him know that there are quite a few questions and comments that have come in through the chat, and you can continue adding if there are others that come up for those in the audience. So we'll just run through them. The first, earlier on during your presentation, do you have the histogram of the ratio of the deal to NPV?
No, I don't think I do have a histogram of that. I put some slides in the appendix. I do have a couple of slides in the appendix here to don't show the ratio, but just show a histogram of the two sets of values. I can show you those, but I think that that ratio is no, I don't have a histogram of that, but I do have a sort of a related one here. This shows the number. This is a histogram, shows the number of deals, and the light green here is the shows the ranges of, or the history shows the after-tax NPVs, and the dark color here shows the deal prices. So you can see that, and this is, I want to point out that this is a logarithmic progression or a non-linear progression. So this is deal values of less than 10 million, 10 to 30. And so you can see that by the time you get to 100 million, there's only a couple of after-tax NPV, or sorry, there's only a couple of transactions that are there at over 100 million. Whereas for the after-tax NPVs, and there are none under 10. So 30 million, 30 to 100, 100 to 300, and there's quite a few of them over 300 million. So you can see that on this basis, you can see that there's it's just another way of highlighting the differences. And here's the same thing for the non-transacted properties here. In fact, it's even more striking, I think, in here with the dark color being the deal values, or sorry, not the deal values, but the adjusted market cap, which was used as a proxy for the property values. And then you can see that here there's no, there's you can see that the histogram for the deal values tapers off, whereas the non-transacted adjusted market caps take off. So I'm not sure whether that relationship between the two would be logarithmic or non-linear progression like this one or not. I don't really have a specific answer for that, but this just kind of highlights the differences again.
Thank you. He goes on to say, this is Brian, so the deal price represents the price an investor is willing to pay for the potential to have a project that might return a cash flow, and the NPV as indicated.
Yes, that's correct.
Okay, there's will the slides or video be available for the group? Bill, are you okay with us posting the video to our website afterwards?
Yes.
Okay, so we'll take care of that in a couple of days. To what do you attribute the variances between NPV and deal price?
Well, that's a good question, and I'm not a mining analyst or a market analyst, so I'm just give my own opinion on that. I think that there's a general realization among sophisticated investors and mining company people acquiring mining companies that do acquisitions. I think there's a general realization there that 5% does not represent real value of a property, so that I guess if I were in their position, I would say, well, what's the real value of this property, and let's look at the risk involved in a project that's has a lot of uncertainty in the PEA, and what's an appropriate discount rate. And so I think that for valuation, they would take the information, the cash flow, and apply their own opinion of discount rate, and then use that as a as a negotiating start anyway. And
Right, so you
I think
brought in,
that to me, that explains, I mean, it's not the only reason, of course, there are other reasons, but that to me explains some of the substantial difference between the two values.
okay, thank you. Patrick asks, so this data suggests that the value of the projects per their PEA NPV valuations is dramatically higher than the value that investors are willing to actually ascribe to a property when they cut a check.
Yes. Yeah. And again,
Okay.
I think that's because the discount rate, the NPV at a 5% of total discount rate is not, especially in a PEA, is not representative of the risks that are involved in that
Mhm.
in that
Okay.
study.
Thank you. So why are investors willing to pay a premium for Canadian properties?
Well, again, that's not my specialty, but I think that we see the same sort of pattern, I think, in US based properties. A lot of them are held by Canadian companies. Again, you know, if I think it's a negotiated thing, and again, you probably wouldn't see very many deals where the company selling the property would be willing to accept something that's maybe just represents the current stock price. Everybody likes to see a premium. I think it's a negotiated thing.
Right. Okay. Thank you. And Natasha asks, in general, were the deals completed shortly after the individual PEAs were published, or were the deals completed once the projects were further developed after the PFS or feasibility, etc.?
These are all after only a PEA, because if there were an intervening study between the date of the PEA and the deal date, of course, we didn't use that deal. So these are all, in some case, there was in a few cases, there was a time difference of 4 or 5 or maybe 6 years between the two, but there was no other study done in the interim. And so, and those seem to most of them were within a year or two of the publishing of the PEA results, most of the transactions. So.
Okay, and that's what Surya does point out here. These transactions were within 1 or 2 years of a PEA. The NPV and the PEA is calculated at the start of construction. An asset with a 1-year-old PEA is still multiple years away from construction, so the deal value should have been compared not to the PEA NPV, but to cash flows discounted to the year of the deal. This may be like discounting the PEA NPV by another 4 or 5 years. This would have brought the deal price closer to the discounted NPV. It would have been great to see what kind of discount rate would have made the discounted NPV equal to the deal price.
Yeah, I mean, that's a subject for another study, I think. Yeah, I mean, we just use the NPVs that, projected back to the date of the PEA. So I mean, there's a lot of variables here that are not necessarily, under control, but but I think that I think substantially, if we look at the overall results here, I think they're telling us a story. I mean, it would be interesting to look at a time delay here. In fact, I gave another talk last week, and that's one question that came up was the time delay between the PEA and the time when it actually went into production. But that would be a whole other study to see what that effect and what the discount rates would be in that case.
Okay. Brendan asks 2 questions. 1, when calculating the implied discount rate of the precedent transactions, are you discounting past the NPV date, say to PEA, which would be years earlier? And number 2, for the same set of calculations, what commodity prices are used? How are they normalized?
Yeah. Okay. Well, for the PEAs, we used the information that was in the cash flow that was published in the PEA. So we just took the I just took the cash flows and then applied different discount rates to come back. And I used the same commodity price that was used in the PEA. So I thought that if there was only a year or two, for the most part, difference between the times, you know, it's going to be close enough. And so there was no change in the commodity prices. There was no consideration of different commodity prices between the time of the PEA and the transaction.
Mhm. All right. Okay. Thank you. Carl was asked, was a sensitivity analysis done on potential project development delays and their impact on NPV?
No.
Okay, thank you. Rod asked, do you have any data on NPV versus actual financial results from mines that go into production, i.e. how close was the NPV to the real world result? Since waiting until the mine has completed production is a long time, do you have data for, say, the first 5 years of cash flow to see how close was it to the NPV estimate?
No, we didn't look at that type of information. I think, again, that would be a really interesting subject for another study.
Yes, more studies could be done. Brian, only about 20% of the PEA and PV is seen as value in the company. That's his question based on the results that you have. Anything to add there?
Well, I think that you know, to some extent, I mean that ratio, if it's the 20%, is he talking about the 20% ratio or the 20% discount rate?
I think it's the ratio.
Oh, the ratio, yeah. So I think that those ratios are, you know, I put them in there just to illustrate a point, and you know, that there's a significant difference between the two. But I think to some extent it's a little bit artificial. It's an artifact of the 5% discount rate or the very low discount rate. And you know, you can see that there's quite a bit of variation in those ratios, even though they're almost all at a 5% discount rate. But the point I'm making there is that there's a substantial difference for most of those studies that have been done. There's lots of other things that might be done as well. You know, I'm just thinking about maybe it's important to look at the internal rate of return because, you know, and maybe there's a relationship between the internal rate of return and that ratio because the internal rate of return gives you an idea of how good a project it is.
Right. Yes, thank you. Natalia asked, why is the market not paying the discounted NPV as it's indicating? I think you did address a question like this earlier, so we'll actually move to the next one. Patrick, a discount rate of 5% is commonly used in PEAs, but a discount rate of 15 to 25% is needed to make the valuation align with transaction values in the market. In reclamation and security bonding for mine closure, discount rates of 1 to 3% are more common. Could you please comment on the discrepancy between the discount rates used for reclamation and security bonding versus project valuation?
I don't think I can comment on that. That's beyond my field of expertise.
Right, so they're clearly using very low discount rates in that business. Okay, let's move on. Adrian, has a similar study been done for pre-feasibility study or feasibility study levels?
Yes, my colleague Pierre Landry gave a presentation a couple of years ago, and he did a similar study on pre-feasibility level studies. There was not as much information, so I don't know how conclusive. But I've got a slide here actually that shows. Yeah, oops, that's copper. At least I thought I did. Where is it? No, I didn't include. Sorry, I thought I'd include. But he did a study that showed very similar results for PEA level, but I think that there was not as much information. Here we had 17 PEAs. I think he only had a half a dozen or so studies where he was able to apply similar techniques and look at it in similar ways to the gold projects, but only at the PFS stage. But he did do a study on copper a couple of years ago as well, and it showed similar results for copper.
Okay, thank you. Jim is asking, so is the goal to pick a discount rate to equate the NPV to the property value?
No, I think that the goal is, I mean, I have no control over that, but I think my recommendation is that PEA should show, and perhaps other studies as well, should show the sensitivity of the NPV at different discount rates, at higher discount rates. I think that's my aim here, is to
Right.
is to make that suggestion. And again, it's something that, I mean, it's something that people would have to volunteer to do, I guess. And I can't. And I think since PEA seem to be somewhat of a marketing tool for junior companies, I can't really see that happening without somebody coming up with a, some sort of a guideline or a industry practice to that effect.
Yeah, just not the norm. And Jeff has a question. We all know the last few years have seen record low gold company values. Given the analysis is based on this period of time, are we lowering the value too much for current and future market conditions?
Well, I don't know if I can answer that question or not, but I think that we've done, we've been SLR and previously RPA have been collecting information on gold transactions. That is on a dollar per ounce basis for gold transactions on a worldwide basis. Again, getting data from the SNL proprietary database, but that's showing. I think that the last couple we've done, typically, they've been presented at the SME. We've had some presentations at other venues, but the last few years, I think that the dollar per ounce values for gold transactions has actually been decreasing, and which is counterintuitive, because the last study that we did that was just presented at the SME in February by my colleague in Denver, Grant Malinsek, showed that the dollar per ounce gold values, both for producing properties and for non-producing properties, has been dropping and continues to drop, not substantially, but it continues to drop, stay level or drop over the last few years, say 5 years, when the gold price has just been rapidly, taking off. So that doesn't really make sense, and I don't know what the cause for that is, but it's maybe all the good product out there has been bought or something, but it's just, yeah, it's interesting.
Okay. Yeah, interesting. So there are quite a few more comments and questions, so we'll press on. The results here are shown for gold properties. Do you have any indications that this deal to NPV ratio would be different for any other commodity, base metals, coal, uranium, etc.?
Well, that's got to be on our to-do list, I think, is to look at some of the other commodities. But as I mentioned, I think that Pierre Landry, my colleague in Victoria, did a study. I've got just a little summary of the, where is it? Oops. Yeah, copper study here. So this is in a couple of years ago, he compiled similar data on copper properties with PEAs, and he had 8 transacted and 14 non-transacted properties from over the last decade. And the discount rates for the PEAs were 5% to 8% for both the transacted and non-transacted. And so again, the deal prices were all consistently lower than the PEAs, and the discount rate for an NPV to equal the deal price is lower for copper than it is for gold. It shows an average of about 13% with a medium of 13%. And for the non-transacted properties, they're all, again, you get the significant difference between the PEAs and the between the NPVs and the adjusted market cap. I'm just looking to see. I can't read the bottom part there, so I have to check my notes.
Okay. Yeah, discount rate. Discount rate for NPV equals adjusted market cap, averages 20%, median 16%.
Okay. Yeah. So the transacted ones would suggest that the discount rates might be a little lower, so they may be a little closer to, which suggests that the ratios are a little closer as well. But that's the only thing we've done so far. I mean, it's on our to-do list for future.
Yes, lots of work.
Take that on as a project, more power to them.
That's right. Okay, Mark asks, in addition to the risk uncertainty associated with future conversion of inferred resources to M&I, say 60 to 65% of inferred ounces convert to indicated with infill drilling, a significant risk. What do you consider to be the other main components contributing to PEA risk?
I think that I mean the capital costs are not very well constrained. I don't think at the PEA level. I mean, people have done studies or published information saying, you know, plus or minus, giving plus or minus numbers for capital costs, and they're typically you know, high plus or minus or ranges for the capital costs for PEA level. I think it's kind of across the board, you know. I mean, there's not much in the way of, or well, it depends on who does the study. On some companies, these are all done, or virtually all done by consulting companies, consultants and consulting companies, and you know, the level of detail, I think, depends a lot on the who does the study, but typically there's not, certainly not as much engineering or cost estimating done for the operating costs or for the you know, the mining method, the production rate, the whole everything across the board, I think, is you know, is a level of uncertainty higher than pre-feasibility and feasibility, certainly.
Yes. Okay, great fundamental work on looking for the main indicators and relating them to reality of valuation. That's on comment. Saria also says here, also a 5% discount rate in the PEA is a real discount rate. None of the inputs in the PEA, in a PEA, like commodity price, OPEX, etc., are inflated over time. A 5% WACC used as a starting point and a build-up cost of capital is a nominal discount rate as its components. Cost of debt, if based on actual comparable debt rates, and cost of equity, if based on beta and observed stock price movements, account for inflation. If a nominal discount rate is used, would it be matched with nominal inflation-adjusted cash flow as well? How would that work for commodity prices?
Well, I mean, again, I don't think, you know, what we've done here is a kind of a high level study, so I don't think we've gotten into that that level of granularity on these things, and so I don't, you know, I don't think I can answer that question with respect to the information that we've used here. Ask Larry Smith.
Yes, all right. Jane says, thanks, Bill, for a useful analysis. Great presentation from Natalia. Carl, thank you for the great content. Patrick, yes, thank you very much, Bill, for really interesting analysis. I appreciate you sharing this with the group. Brendan, does the implied discount rate vary by commodity as well, considering the example that gold is often discounted at 5%, whereas copper is generally at 10%, etc.?
Yeah, well, yeah. I think from studies that have been done by Larry Smith and Ross Lawrence, I mean, they've done surveys on base metals as well as gold, and in general, the base metal discount rates are people use higher discount rates for base metals than gold.
Right. Yes. Comment here from Laurel. Discount rate in the range of 10 to 15% is, in my opinion, most appropriate for a PEA, as it accounts for the high level of project risk at this early stage. So that's addressing the risk issue you mentioned. Stephen says a buyer, no matter how willing, would not agree to pay 100% of the NPV for a project at any discount rate. There is nothing to be gained in that. The willing seller knows that they have to leave enough on the table to make the deal happen. It's a starting point for negotiation only. I think a point you made as well.
Yep, I'd say fair enough. Yeah.
Yeah, fair enough. Right. Omar says, do all the evaluated projects have inferred resources, or do some of the deals involve better defined resources at the PEA stage? Does the level of resource definition also impact the discount rate?
I don't think I can answer that question. We haven't done that, looked at that in enough detail. I think the amount of inferred resource is kind of all over the map in these 65 projects that we've looked at. And I think that might be an interesting area for further study as well. But I sort of feel intuitively that it probably doesn't make a huge amount of difference between about the amount of inferred resource compared to indicated and measured here. I think it's, you know, I think that people just tend to look at the overall resource at the PEA stage and not worry too much about how much of each. Although, you know, that's subject, of course, to you know, digging into it in a little more detail.
Right, right. Thank you. Claude says, thanks for this insight. Looking forward to the next session. Ross says, I will chat directly to Bill. Please take a look. And I think, is that it? A couple of new messages. What's the advantage of using a higher discount rate versus using a probability-based valuation? For example, a 30% chance of getting 100% of the NPV, 5%, and a 70% chance of getting nothing.
Well, I don't know. It might be worth taking a look at. I mean, probabilities of are kind of problematical, I think, when they're applied to you know, whether something's going to go into production or not go into production, or whether, you know, probability of making a discovery or making a, you know, I think there's just too little in the way of information to come up with probabilities.
Right. Okay, last comment here. Using a higher discount rate is a simpler way to account for risk and uncertainty, especially at the PEA stage. In contrast, a probability-based valuation can be more accurate in theory, but it introduces complexity and requires robust, defendable probability estimates. This level of detail may not be appropriate or justifiable in a PEA where data is still limited and assumptions are highly uncertain, in my opinion. So that is from Laurel. So good discussion there. And again, thanks to all those who sent in questions and comments and those who are here. Carlos, I think I'll hand it back to you.
Sounds
and
good.
To wrap up.
Sounds good. I'm gonna switch you off. Give me 2 seconds. Bear with me for 2 seconds. Replace current share with this. Okay. So can everybody see this? Okay. Okay. So in the next few days, this recording is going to be posted on our website. So I encourage you to go under national right here. If you go to cimmes.org under national, click here and you will see this right on the right hand side in this orange. Well, it's orange to me because I'm a bit colorblind, so it looks orange. Under highlights from past CIM events, click here and you will see it posted right here in the beginning of this list of past events, right? I encourage you not just to click on the recording of Bill's presentation, but also some of our past events if it interests you. So have a look through this list. There's quite a few videos that have been posted, so I encourage you to take a look at it and so on. If you're interested in getting notifications of future events, okay, again, I want to stress one thing. We do not share our mailing list with anybody. So in other words, if you share your email address, we will respect it and we'll keep it private, but we will inform you of upcoming events. And so if this interests you, just hit here, contact us right here, right? And just fill out this and make it known to us that you're interested in getting added to our mailing list, and we'll inform you of upcoming events. Our next event is actually a short course event, and it's going to be on May 29th. If it interests you, right, just click here, and there's full information about it. Our next discussion group event is going to be featuring Alex Pazel from Castles, which is a Canadian corporate law firm, and he's going to be focusing on NI 43101s. So that should be a very good presentation. So do register for it. The one that we do ask, if you do register, please join us, just because we are limited in how many people we can allow into the Zoom room. And so if you register, do make it a point to join us that day. So
Before you wrap up, Carlos, one quick question that
anything.
got missed here from Gordon. Bill, in the list of risk components that comprise the discount rate that Larry Smith provided, would not the risk attributed to a junior developing the project be higher than the 1 to 2% suggested because of the significant financing development risk for the asset to get it through to production, i.e. the biggest risk to generating the forecast cash flow stream estimated in the PEA is financing risk, is likely closer to 10 to 12%, which would raise the overall discount rate to the 20% level your analysis suggests.
Well, that's a fair comment, but I can't really comment on that. I think you know, might be a good comment for Larry to come up with. I mean,
Right.
fair enough. Yeah.
Right.
I mean, I mean,
Yeah.
I think a lot of juniors are not necessarily going to try and put the property into production themselves, so they're going to try and sell it to a major.
Yeah. Yeah. Okay. Well, another consideration of risk. Okay, Carlos, I'll hand it back to you
Okay.
again.
So thank you very much. So this concludes this event. We want to express our sincere thanks to Dr. Bill Roscoe for his informative and engaging presentation. We also want to thank you for joining us today. And of course, we want to thank our sponsor, IM Gold, for making this seminar possible. We also want to thank the CM Foundation for generously sponsoring this event as part of the CIM Distinguished Lecturers Series. Like I mentioned before, if you are not already on our mailing list and you would like to receive notifications about future MES events, please complete the mentioned form. And rest assured, as I said before, we do respect your privacy and will not share information beyond MES and CM as needed. We look forward to seeing you again at one of our upcoming events. So thank you very much and have a great day. This concludes today's event.
Thank you.
Thanks, Bill.